So a nice question to initiate a finance course devoted to the foreign exchange market is deceptively simple. According to you, what date marks the creation of the foreign exchange market? Or, to put it perhaps more prosaically, from what point does one need to cover the risks of currency variation? The answers are invariably diverse. Many students choose an easy answer, well, since always. Others speak of barter and trade, and some mention primitive forms of money, seashells and the like. But in fact, the history of the foreign exchange market is complex. And as a result, this question is fairly racking. In effect, we've gone through long periods over which currencies are remarkably stable. And these periods may be characterized by monetary systems based on gold. And in addition, we've also had floating systems, currency unions, crises, and etc. And despite this complex history, there is a founding event that marks the beginning of the foreign exchange market as we know it today. And it is the suspension in 1971 of the US dollar's convertibility into gold. In fact, the Second World War begins the supremacy of the US dollar. In 1944, the Bretton Woods Agreement established the first real international monetary system to regulate the movement of currencies and restore economic stability. This agreement inaugurates the primacy of the US dollar by authorizing that this currency can be convertible into gold at a fixed exchange rate of $35 per ounce. Indeed, the United States possessed 3/4 of the world's gold reserves, and the dollar thus becomes the global reference currency. Further, the exchange rates of other currencies become effectively fixed to the US dollar. And to maintain this system, other countries must ensure the convertibility of their currency at any time. The central bank must intervene in the event of any misalignment, and cross-border capital movements must be carefully controlled by governments. Specifically, under such a system, central banks are obligated to intervene to maintain the parity of their currency. Currency depreciations between countries become impossible. Now, despite this perceived stability of the system, global investors lose confidence in the US dollar as early as the 1960s and ask for conversion of their dollars into gold. As a result, the US stock of gold falls below the total amount of US dollars. Now, because of this steady decline of their reserves, the dollar's convertibility is unilaterally suspended on August 15, 1971 by US President Richard Nixon. From that point, global currencies are floating. And by 1973, the foreign exchange market as we know it today is taking shape. Despite constant attempts in the ensuing years by central banks to control foreign exchange rate fluctuations, the market becomes the dominant force behind global currency movements. The exchange rate between currencies depends largely on market supply and demand. Currency prices, the dollar in euros, the yen in dollars, etc., vary continuously depending upon the transactions carried out in trading rooms around the globe. Major central banks, in both managing the supply of money and securing the level of short-term interest rates, have often attempted to influence the foreign exchange market, and they may from time to time argue that foreign exchange speculation has gone too far in pushing the depreciation or sometimes even the appreciation of their domestic currencies. They can intervene directly in the foreign exchange market by buying or selling currencies, and this can be done alone or sometimes, for more efficiency, in concert with the central banks of other countries. For instance, the US Federal Reserve and the European Central Bank have acted together in the past to influence the euro-dollar exchange rate. So it is natural to ask, what are the criteria by which investors buy and sell their currencies? For example, what does it mean to say that the dollar is strong? Essentially, such statements require an assessment that the market rates are above or below some notion of a real or fundamental value. And to assess a rate of equilibrium, it is necessary to analyze a battery of economic indicators. We often consider the differences in inflation rates between two countries, interest rate or monetary policy differentials, information on relative balance of payments and trade accounts, amongst other things. For instance, consider a country displaying a large trade deficit. Now, one might imagine the value of its currency will consequently depreciate to help narrow that deficit and the associated reliance on external financing going forward. In effect, the value of the currency may evolve to help rebalance the external funding needs of respective economies. Now, all this said, other macroeconomic factors can also influence the value of one currency in relation to another. Thus, in order to ascertain whether a currency is over or undervalued, it is necessary to determine some kind of exchange rate equilibrium. To be clear, while most economists generally agree on the rough determinants of exchange rates, precise macroeconomic models do not generally yield identical implications for a currency's fundamental value. Simply put, there is never a single and unambiguous measurement of the degree of over or undervaluation. Now, there are two relatively dominant theories that can help guide a determination of the theoretical value of a currency. The first is based on a parity condition implied by the prevailing interest rates across two economies. It is called the UIP, or uncovered interest rate parity. In effect, if a country offers a high interest rate, higher than other countries to be clear, investments in this currency are particularly valuable to international financiers. All things being equal, this supports the direction of the currency's value, as global traders must buy this currency to purchase local assets. As a result, interest rate differentials across markets can and do influence currency fluctuations. But this is only one among many relevant economic and financial variables. Another is associated with different levels of purchasing power across markets. To make this clear, suppose you want to buy the latest iPad. You could explore the US dollar price of the iPad in New York, or you could explore the price in euros for a purchase in Paris. For this particular pair, it's not uncommon to see that the prices of this product are the same, despite being expressed in two different currencies, one in euros and the other in dollars. Now, this might strike you as odd, since this is, without considering the exchange rate between the two currencies, not an apples-to-apples comparison. If the market were completely efficient, borders and custom duties banished, and transportation costs negligible, all the buyers would simply head to the cheapest place in absolute terms. Further, by a simple process of supply and demand, the exchange rate adjusted prices of the same product across all countries of the world would then be the same when considered in the same currency. So in our example, this equality of the price of the iPad in Europe or the United States could only be possible if 1 euro equals $1. However, that hasn't been the case for some time, so our observation correctly seems odd. More generally, we are underlying an idea connected to differential purchasing power. Purchasing power parity, as it has come to be called, establishes a unit of measurement that permits one to compare the purchasing power across different currencies. In its calculation, purchasing power parity intentionally ignores the market exchange rate and rather focuses on differences in the costs of goods and services across countries. In fact, one of the most popular indices of parity is the Economist newspaper's Big Mac Index, for which they compare the price of the famous hamburger in most of the countries of the world. More generally, one can determine a theoretical exchange rate that would comply with a cross-country equilibrated purchasing power. Indeed, one can start with a representative basket of goods and services in two currencies. Comparing the price of this basket gives us the theoretical value of the exchange rate. And if the representative basket is worth, say, 105 euros or 145 US dollars, the theoretical exchange rate implied by purchasing power parity would be 1 euro to $1.3810. Now, suppose the euro is instead worth 1.41 US dollars. This is the market exchange rate. We could then argue that the euro is potentially overvalued, as it costs more US dollars to obtain 1 euro than would be implied by the prices of the same basket of goods across the two areas. Of course, this measure requires a number of heroic assumptions, and hence only allows us to establish a rather imprecise ballpark number. However, huge differences in purchasing power do give one a sense of the economic pressures that are weighing on a currency pair. These may not tell you precisely where an exchange rate will move in the short run, but an understanding of this dynamic is valuable for longer-term analysis. A trader ignores these kinds of economic pressures at their own peril. So what are the key points to retain from this video? First, the suspension in 1971 of the US dollar's convertibility into gold has led to foreign exchange markets as we know them today. The exchange rate between currencies depends largely on market supply and demand, and the real or fundamental value of a currency depends on the macroeconomic health of a country: inflation, monetary policy, interest rates, balance of payments, trade accounts, unemployment, growth, etc. Uncovered interest rate parity is the theory that values currencies on the basis of their interest rates. And purchasing power parity is the theory that values currencies on the basis of the costs of goods and services.